Good day, everyone, and welcome to another episode of Learning. Today, let's talk about financial statements. What are financial statements? Financial statements are reports that summarize the financial performance and position of a company. In short, financial statements are documents reflecting the money or financial resources of the company. It tells us where the money came from, what are the sources of capital, was the money contributed by the owners or shareholders of the company, or did it come from borrowings? It also tells us where the money went. Was it used for capital expenses, such as acquiring property, plant, and equipment, or payment of office rent and other business expenses? Or was the money spent on paying operating expenses such as utilities and salaries and wages? Financial statements also show us where the money is at present, reflected in the cash balance of the company. How liquid is the company? Does it have sufficient liquidity or cash to pay its existing obligations, both short term and long term? How much is the company's working capital? Aside from the sources of financing, the spendings of the company, and ending balance of its cash, financial statements also tell us where the money is going. Will it be used for expansion or reinvestment objectives of the company? All of this information are contained in the financial statements. Now, who are the stakeholders of the company that use financial statements? We have shareholders and investors. They'd like to know how much capital would be needed to start a business or sustain the business, or how much additional capital or investments are still needed. For a prospective investor, they rely on the financial statements in deciding whether to invest their money or not in a certain business or company. Management uses financial statements in its operating decisions on a day-to-day and regular basis. Creditors and lenders look at the financial statements to measure the capacity of their borrowers to pay their obligations and thus decide whether to grant, approve loans or not. What about employees? Employees are basically concerned about their benefits from the company, the retirement fund or pension fund that they'll be receiving, and are concerned about their future in the company. Next are competitors, wherein they use financial statements of companies and even industry for comparative analysis. The government, especially the regulatory agencies of the government, require companies to submit financial statements for compliance and monitoring purposes. Next, unions for collective bargaining agreements. Another user of financial statements are rating agencies that use financial statements as one of their criteria when providing credit rating of companies. We also have vendors that assess credit risks. And then other users of financial statements are customers, general public, analysts, and even students that use and read financial statements for academic purposes. All right. So these are the basic financial statements. We have statement of operations, also known as income statement, profit or loss statement, or statement of comprehensive income. We also have statement of financial position, also known as balance sheet, and then cash flow statement, statement of changes in equity, and notes to financial statements. Let us start first with income statement, also known as statement of operations. It measures the overall financial performance of a company. This report shows two things: all the revenues and all the expenses incurred by a company. So basically, income statement tells us what a company earns through a period of time. So the basic equation is sales revenue minus expenses is equal to net income. Sales revenue is what the company earns from the sale of its goods and services. And then expenses include costs, operating expenses, interest expenses, and taxes. Cost of goods sold, for instance, include cost of raw materials, cost of direct labor, overhead costs. And then we also have operating expenses such as payment of salaries, utilities, and the result is net income, which means all costs and expenses are deducted from the sales of the company. How are financial statements presented? In an income statement, we can see here 3 lines as heading. The first line is the name of the company. The second line is the name of the financial statement or type of financial statement. In this case, statement of operations. And the third line would have to be the reporting period. So here it's stated for the year ended December 31, 2020. Meaning to say that the reporting period starts from January 1, 2020 to December 31, 2020, or for 1 year. It reflects the sales and all the costs and expenses of a company from January 1, 2020 up to December 31, 2020. Every income statement begins with the company's revenues or sales by multiplying selling price by the number of quantity sold. Sales revenue or sales in Tagalog is benta. From sales revenue, cost of goods sold in Tagalog is puhunan, will be deducted from the sales revenue to arrive at gross profit. Operating expenses such as general and administrative expenses like salaries and wages, rental expense and utilities, and also selling expenses such as advertisements are operating expenses and are deducted from the gross profit. The result would be operating income or operating profit. Interest expense, if any, will be deducted to arrive at net profit before taxes. And then we deduct taxes. The result is net profit after taxes or simply net income if there are no cash dividends. In this case, dividends were paid and deducted from net profit to arrive at net income, or also known as earnings available to common shareholders. If you would like to know how profitable a company is, one way is to look at the company's income statement. Again, the basic equation for an income statement is revenues minus expenses is equal to net income. Remember these 3 major items, this financial information presented in the income statement. We have revenues, expenses, and net profit. Sales revenue would include all the sales generated by the company from its primary activities and other income. And then expenses would include cost of goods sold, operating expenses of the company, interest expense, if any, and tax expenses. Now, balance sheet, also known as statement of financial position, it measures the overall financial health of a company. It presents all the assets, liabilities, and equity of the business. Balance sheet is categorized into 3. We have assets, liabilities, and equity. The general equation is assets minus liabilities is equal to equity. What are assets? These are the things that the company owns, such as cash, marketable securities, inventories, machinery and equipment, furniture and fixtures. What about liabilities? This is what the company owes to its lenders or creditors, such as loans payable, rental payable, or utilities payable. And equity is also known as retained earnings. This is what we get after deducting liabilities from assets. It tells us about ownership. The heading of a balance sheet would start with the name of the company. The second line would be the type of financial statement. And the third line is the reporting period. You can see here that the reporting period is stated as of December 31, 2020. Now, the question is, when did the reporting period start? So if the company commenced on June 30, 2000, it means to say that the reporting period starts from June 30, 2000 up to December 31, 2020. Now, for ratio analysis, you can actually find the figures in the balance sheet that would measure the company's liquidity and stability. Again, the balance sheet equation is assets minus liabilities is equal to equity. The 3 main categories, assets, liabilities, and equity, are presented in a balance sheet. For sole proprietorship form of organization, we use the term capital. For partnership, it's partners' equity, and for corporation, stockholders' equity. As you can see here, the total assets of the company is 7,600,000, which is the same as the total combined liabilities and equity of 7,600,000, which translates the previous equation we mentioned as the same as this equation. Assets is equal to liabilities plus equity, which means that assets must always be equal or balanced with the company's total liabilities and equity. Now, let's proceed to cash flow statement. It shows all the cash receipts or cash inflows and cash disbursements or cash outflows of the business. Remember that only those transactions that affect cash account will be included in the cash flow statement. Transactions such as purchase of inventory on credit, meaning to say no cash outlay, would not be part of cash flow statement. However, purchase of inventory in cash will be reflected as cash outflow in the cash flow statement. Cash flow statement is classified into three categories. We have operating activities, investing activities, and financing activities. When we say cash inflow or outflow from operating activities, these are cash transactions related to the production, manufacturing, distribution, and sale of goods and services. So these are cash transactions or activities that affect net income. Net income, depreciation, interest received from loans are considered cash inflows from operating activities and therefore added in the statement. Cash payment to suppliers and income tax payments are both cash outlays and therefore reflected as a decrease in cash under operating activities. Next is investing activities. These are cash transactions related to non-current assets, such as property, plant, and equipment. Examples of cash inflows from investing activities are proceeds from sale of investments and assets. On the other hand, purchase or acquisition of assets such as capital expenditures like acquisition of machinery and equipment, buildings, are reflected as cash outflow. Lastly, financing activities involve cash transactions related to raising money from debt or stock issuances. In short, they are related to non-current liabilities. Take note, non-current liabilities are reflected under financing activities, whereas current liabilities are reflected under operating activities. Examples of cash receipts from financing activities are issuances of new capital and new debt. Repayment of debt and dividend payments to shareholders are considered cash outlays and therefore must be presented as a deduction in the cash flow statement under financing activities. Statement of changes in equity basically shows us two things: transactions that either increase or decrease equity or both. This report accentuates changes made in the equity investments of owners. It must contain the following: increase in net income or decrease in case of net loss, additional capital contributions, withdrawals, and dividends or profit sharing distributions, if any. As you can see, statement of changes in equity is presented similar to the heading of an income statement. For example, the beginning balance on January 1, 2020 is 5 million pesos. Then the capital contribution of business owners or shareholders are added. And then net income is also added. If it's net loss, we have to deduct net loss here. And then dividends distributed to shareholders would also be deducted. So the result is the ending balance, which reflects the changes made in equity. Notes of financial statements, also known as footnotes. They are explanatory notes that provide detailed information about at least three things: the accounting policies of the company, which include accounting methods used, such as depreciation method, inventory method, and also disclosure of accounts and amounts, breakdown of amounts not presented in the financial statements. And last but not the least, any additional information such as contingent liabilities or if there are contractual commitments and other non-financial disclosures. So we have to remember that notes to financial statements are an integral part of financial statements since companies are required by what we call full disclosure principle. So notes to financial statements serve as a basis in the preparation of financial statements, particularly as to how a company arrived at its amounts and overall presentation of its financial statements. All right, to summarize the basic financial statements, we have statement of operations or income statement showing the company's revenues and expenses. We also have a statement of financial position or balance sheet, which is categorized into three: assets, what the company owns; liabilities, what the company owes; and equity. And then cash flow statement, which is categorized into three: all the cash inflow and outflows resulting from operating activities, investing activities, and financing activities. Statement of changes in equity, and last but not the least, notes to financial statements as supplemental information to the other four basic financial statements. That's it, guys. Like, share, and subscribe if you have learned valuable information from this presentation. Have a great day, everyone.